Hey, welcome in, gang. Thanks so much for joining me. Is the Fed hyper focus on inflation going to overdo it? We're going to talk about that today. Welcome in again. This is Sean Richard, Mortgage Team, SRT Live with me, your host, Sean Richard. Thanks so much for joining me today. Lots to talk about today. We had a busy week last week. We got some housing data. We got some appreciation data today. As always, we get jobless claims, unemployment claims. And then last week, we had the Jackson Hole Symposium. And so we're going to talk a little bit about what we heard out of the Fed Chair Jerome Powell in his remarks on Friday. So let's get started. Let's start with last week's roundup. So we got pending home sales last week. Pending home sales, the expectation that they were going to come in down 4% month over month. Guess what? They came in only down 1% month over month. So home sales still running strong. We're seeing the market soften, but we've got some strength in the housing market. We also got jobless claims every Thursday. So last week, last week, the expectation is that we're going to see 253,000 new jobless claims. Again, for those of you new to the podcast, jobless claims, this is unemployment claims. It's initial and continuing. Initial is individuals filing for unemployment for the first time. Continuing is people renewing their unemployment benefits. So initial claims, market analysts were expecting 253,000. This was after a 245,000 mark the week prior. We actually got 243,000. So this is two consecutive weeks that we've seen jobless claims, unemployment claims dip below 250,000 for a week. We're still up quite a bit from where we were earlier in the year, but it's something that we want to watch. Continuing claims came in at 1.415 million. This is actually down from the previous reading of 1.434. And the analysts were expecting also a little bit higher at 1.442 million continuing claims. So again, we're seeing a decrease in that. Also, why we've been seeing a strength in the employment market. So we want to see where that trend is. We were trending up. We've kind of stalled or plateaued a little bit. Where we head into the fall is going to be an important mark for where we're heading as an economy and where the jobs market is heading, or the employment market. We also got the second reading of GDP last week. Now, this is important. There's 3 readings of GDP. We had the first, which came in at a negative 0.9. And if you recall, this is for Q2. So in Q1, we got a negative GDP reading. And then the first reading for Q2 was negative 0.9. The expectation from analysts is that we were going to get a negative 0.8 reading, but we actually got a negative 0.6. So that came in a little bit lower than anticipated. Now, still negative, and the historical traditional definition of recession is 2 consecutive quarters of negative GDP. So it looks like we may be on the verge of calling this a recession, at least by older definitions. They've revamped definitions, and now a recession also is measured by the length and the breadth of the recession. But we're not going to find out if it's a recession till long after the fact. They're not going to call that till probably next year. All right, we also got PCE. This is a big one. We got this one on Friday, and this is personal consumption expenditure. This is the Fed's favorite measure of inflation. And the Fed is targeting 2% inflation. And so that's what they're shooting for. They want to bring inflation down from the 40-year highs that we've seen down to that 2% range. So PCE is one of the big reports that they look at. You recall the other report is CPI, Consumer Price Index, but PCE is where it's at for the Fed. So month over month, PCE came in at a negative 0.1. This is a big deal because this is a far departure from the month prior where we saw a 1% increase in inflation. So as always, we want to look at these numbers and take them with a little bit of a grain of salt. All of these numbers that I talk about are typically revised by the time the next report comes out. Sometimes there's revisions higher, sometimes there's revisions lower, but typically they are revised nonetheless. But a negative reading shows that inflation appears to be coming down. And the Fed rate hikes hopefully are doing their job. And we're probably going to see some more rate hikes here in September. Now, year over year, PCE came in at, oh, I apologize, I lost it. There we go. Came in at 6.3, down a little bit from the 6.8 expectation, down a healthy amount from the previous reading. I'm sorry, the expectation was 7.4. The previous reading was 6.8. So we are down year over year as well. And that's exactly what we want to see. Remember, if you're a home buyer or if you're a real estate agent, inflation is the enemy of interest rates. So as that inflation starts to subside, we're likely going to see interest rates trickle downwards as well. We also heard from Jerome Powell last week, and that was a pretty important commentary that we got from him at the end of the Jackson Hole Symposium. The short of it is, he had stated that the Fed is going to maintain their aggressive stance towards fighting inflation. Now, what does that mean? Well, the last two Fed interest rate hikes, we saw 75 basis points or 0.75. And the market had been pricing in probably a 0.5% increase at the September meeting, September 20th and 21st. Well, with Jerome Powell coming out and mentioning that they're going to keep an aggressive stance towards battling inflation, that opened the door for another 0.75% rate hike, which the markets didn't necessarily love. Remember, when the Fed increases the Fed funds rate, although yes, it battles inflation, and as inflation comes down, interest rates on mortgages come down. What the Fed funds rate increasing also does is it increases the cost of shorter term borrowing. So corporations borrowing money gets more expensive. When you're talking about auto loans or personal loans, credit card interest rates, all of those things are impacted by short-term rates, which is the Fed funds rate. So we're seeing a sell-off in the market over last week, mostly due to the market not liking that information. If we see another 0.75% increase in the Fed funds rate, it does push those costs for corporations and consumers higher in a lot of different areas. Now, the Fed was already planning on probably doing a 0.5% increase, and they've got another meeting in November and a final one in December where they could have done smaller increases to get to their target, which is approximately 3.5%, putting that Fed funds rate at 3.5% by the end of the year. So if they proceed with a 0.75% increase, the question is, where are we going to end the year? So we'll want to keep an eye on that. Again, Fed meeting coming up, September 20th, 21st for this month. We're going to watch that closely. All right. So what's going on today? Today, we got some great information out of Case-Shiller and the FHFA for home price appreciation. FHFA, Federal Housing Finance Agency. Case-Shiller is the gold standard for home appreciation, and it came in with some robust numbers. The previous reading for year-over-year appreciation from Case-Shiller was 20.5% nationally. Now that's a big number, and personally, we're not going to sustain that forever. We do want to see that eventually come down, so that way we don't overinflate values. I know a lot of you think we're already there, but home prices will continue to appreciate, but we're going to see that appreciation at a slower pace. And so the reading for year over year came in at 18.6%, still extremely robust. And there's definitely a breakdown of different areas. Some areas are going to be hotter than others, but an 18.6 year over year reading nationally is extremely robust appreciation. Now, FHFA also puts out their appreciation, their home price index. That one, their month over month number was actually just 0.1%, quite low for what was expected. The expectation was closer to 1%, and a far cry from last month's month over month reading of 1.3%. So we saw that dip pretty dramatically. And year over year, FHFA has us at 16.2% appreciation. Now, one thing to note as far as a difference between the FHFA home price index and Case-Shiller is FHFA only measures homes with a conforming loan. And so conforming would be non-jumbo. So it doesn't take into consideration any jumbos, and it also doesn't take into consideration any cash purchases. And we've seen a healthy amount of cash purchases over the last 12 to 24 months. So let's take that with a little bit of grain of salt. And it also only accounts for purchases. It's not reading home price appreciation on homes from refinances. We also got the apartment list rental report. Now, this was a big one because in August, we saw the increase in rents dip from a year-over-year number of up 12.3 to up 10%. Still a dramatic rate of increases to rents. So the battle for appreciation versus rent increases still leaning in the favor of buying by far. But we want to watch that. It's cooling, but it's still robust. Month over month, it was up 0.5%. All right, so let's look ahead to this week. What do we have? Well, as always, we get Thursday's jobless claims, so we're going to look at that for trending. Wednesday, we get the ADP payroll report, and if you've been watching me for a while, you know that that is a precursor to Friday. We get the Board of Labor and Statistics jobs report, and we get the unemployment rate. So that's going to be a real big one this week. We want to keep an eye on where that comes in. The expectation from market analysts is that the unemployment rate is going to stay the same. So we're going to see where we land with that. I know I've been talking these last couple of weeks about additional layoffs. We've heard it in the news. We've seen a lot of companies, larger companies, laying off workers. At some point, that's likely going to trickle into these numbers, maybe on a heavier pace. So we're going to keep an eye on that. All right. So before we wrap up, I want to talk about what we are talking about right now. And the big point that I want to make is I want to talk about the difference between deceleration and decline, because we're seeing some deceleration in the housing market. We're seeing home prices we're seeing home prices appreciate at a slower pace. But that is very different than a decline. Remember, a decline would be negative, whereas a deceleration means we're simply going from a higher speed to a lower speed. Imagine you're on the highway, you're doing 70 miles an hour, and then you exit, and now you're on the access road, and you have to do 40 miles an hour. So either way, you're still moving forward, you're still making progress, but you're moving at a slower pace once you exit. Home prices are doing the same thing right now. We are still seeing home price appreciation at a relatively healthy clip. You heard Case-Shiller's up at 18.3, 18.6, but we are starting to slow down. And so if you're a home buyer, the market has softened. Great opportunity for you to get into the market. You're not seeing 20, 30, 40 offers, 30, 40, 80, $100,000 over list price right now in the market. So an awesome time to re-enter the market if you've been on the sidelines. If you're a real estate agent, these are great conversations to have with your clients. If you're not already having them, you need to be having these conversations about the market softening and of home appreciation continuing to be strong. The housing market has been robust. It's currently robust. We are softening. We are decelerating in a valley in appreciation, but we're still in an extremely fantastic spot. All right, gang, that is all I have for you today. Don't forget to leave any questions or comments down below. If you're watching this on the Powerhouse YouTube channel, make sure that you hit that subscribe button so that way you get updates every week coming to you, to your phone, to your computer. And until next week, thank you so much for joining me on this episode of SRT Live. I'm your host, Sean Richard. Have an incredible day.